You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Thursday. Today still bright and sunny, but we're going on the dark side of my portfolio. So yesterday, I've discussed my 5 top performing holdings, and I added a special mention for TELUS because it's been a while that we haven't seen this one performing a little bit. So that just was nice. But the top 5 was actually Stantec, TMX Group, Nutrient, Franco-Nevada, and TerraVest Industries. Not all of those are full position, actually. Only 2 of them are full position, TerraVest and Stantec. For the other 3, there are part of like my Smith Maneuver, like small portfolio that I just started. So, of course, did not have a major impact on my assets, but it was just fun to see what was performing and why it was performing already. So this time, we're going to do the opposite, and I'm going to look at my worst top 5 performers, Canadian only. So I'm not talking about US stocks here. Just to see if there was like a few bad stocks around. To give you an idea, if you despite all the uncertainties, the tariffs, the potential recession, and the craziness all around, did you know that if you have just stayed invested in the TSX 60, so like buying XIU, like plain and simple, not doing anything, right now you would be up since the beginning of the year by 6.5% as of May 27th. Kind of crazy, right? 6.5% return, like positive, not negative, like positive, by doing nothing, like just letting your portfolio grow. And in perspective, the S&P 500 is actually not that bad. It's actually like at minus 0.82. So we can say -1. If you're in VFV instead and you have like the currency factor kicked in, you're actually at -4. So a little bit lower, but then again, not crazy. With all that craziness, with all like the end of the world is coming and the economy is going to crumble and Trump is going to destroy North America. Well, I mean, not that bad. I mean, I'm looking at my portfolio, and actually my top 5 worst performers are actually not that bad either. So let's get started. Of course, they all the results are as of May 26th because I pulled out the information for both the best performer and the worst performer on the same date. I include the dividend being reinvested, so don't tell me, oh yeah, but you forgot about the dividend. No, it's included in there, and it's important. I mean, the dividend is one part of your return. The other part is the stock price fluctuation. One is as much important as the other because they're all part of the total return. So if you just focus on capital gains or capital losses and you don't look at the dividend, or you just focus on the dividend and you ignore the capital gain or the capital losses, you're not doing the right math. Like the total return is what is important here. So the first one is actually not a big position. It's part of my Smith Maneuver, and it's Exchange Income Fund. I'm sorry, not income fund, but actually Exchange Income Corporation. EIF.TO. I'm gonna put all of those in the description below for sure. This one is -2. It's a small cap industrial company split between aerospace and aviation, offering mostly transportation up north in Canada. So very niche, but very doing well. And the other part is actually manufacturing, but manufacturing not necessarily about aerospace and aviation. It could be like manufacturing of all kinds of other stuff. Like we have like multi-story window solutions, precision manufacturing and engineering, environmental access solutions. So all kind of like little bits and pieces. They grow by acquisition there. It's cyclical, but it like the fact that they have both kind of do well. The stock price was greatly affected by the Liberation Day, but it's back on track to pretty much fully recovered. So that's why it's only minus 2%. So then again, not the end of the world. It's a small cap. That could happen. I kind of like this one. Had a good quarter, actually. So I don't see any problem here. That's probably why the stock price kind of like went back as they reported in May. Revenue was up 11%. Earnings per share adjusted was up 40%. The cash flow was, the free cash flow per share was also up by 23%. So long story short, not much here to worry about. It's just the market being the market. And that's a good example. Like, and the next one is going to be the same thing. Granite. Granite REIT down 2%. This one quite frustrating because it's not performing at all. The stock price keeps on going down. But when you look at the numbers, it's kind of crazy. I mean, revenue went from 139 million up to 154.7. The AFFO per unit from 122 to 141. The FFO payout ratio is at 60%. It was at 67 last year. The company keeps on growing. Occupation rate at like 94.8, a very slight decline from 95% last year for the last quarter for Q1 of 2025. So the stock price does not perform, but the investment thesis about having a strong industrial REIT in a great market specialized in e-commerce distribution, like technology warehouse. And of course, we have Magna that is a downside. But besides Magna, the company is doing incredibly well. High occupancy rate, revenue is growing, the AFFO per unit is growing, the dividend is growing, the payout ratio is like actually decreasing, which is good news. And yet, no performance. I'm down 2% on this one. It's frustrating because you don't get the results you wanted, but the thesis, the numbers are good, so I can sleep well at night with this. I consider like company like Granite kind of like the GIC, the bond in my portfolio, in the sense that I don't really care about the value because I know that there is a pretty good value there and it's going to eventually come up because the numbers are good. And in the meantime, I get the yield, I get the increase, so I'm willing to wait on this one. Following one, actually, Canadian Natural Resources. Ironically, I did not buy it in 2020, 2021. I was late in the party, but that was not the point. The point was, oh, you prove me that you can go through a crisis and still increase your dividend. Yeah, a little bit of exposure of energy sector could be interesting, would not hurt my portfolios. It was for the sake of diversification, but I also consider this one as a deluxe bond, as a stock that the stock price will not do much, but the dividend will continue to increase. The business model is really solid. They're profitable as long as the oil barrel is trading above like 35.40. So we're far from this. No worries here. So I'm down 3%, but I'm definitely happy with this one. Next one, Brookfield Infrastructure is also part of my Smith maneuver. So small position there. Not much, but that's okay. It's down 5%, including the dividend. That's also another story. It's kind of ironic because the 5 worst performers of my portfolio, they all have decent metrics or good metrics, and yet the stock price does not perform. This one is down minus 5%. I just love having this one in the Smith maneuver because it brings diversification. It brings a good yield. I know that the dividend will continue to increase. It's kind of like the point because with the Smith maneuver, I can use the interest that I pay on the amount that I borrow, and then I can deduct it from the dividend that I receive to make my tax bill a bit lower. So in the rest of Canada, you can deduct it on across all your portfolios. On my side, all your income, sorry. But since I live in Quebec, I can only do that against dividends. So having a few higher yielders in my Smith maneuver portfolio makes sense. So in the meantime, I'm not worried about it. I'm not going to lose any sleep. Kind of like that diversification anyways, but yet down 5% while the Canadian market is up 6.5%, as I told you. That starts to make a big difference. And the worst, and definitely that's a full position, so I'm taking this one in the teeth right now. Alimentation Couche-Tard, one of my favorite stock, is down 13% year to date. Not a good year for Alimentation Couche-Tard, to say the least. Let's just say probably not a good, 2 years now? Almost getting close to 2 years. The thing with Alimentation Couche-Tard, yeah, pretty much like since February of 2024, and then it was like downhill, uphill, downhill, uphill, downhill, uphill. Now it's like downhill. So, uh, not a good performance so far. The market, and it's not the first time, and a lot of people tend to forget about that. If you just go back not too long ago, in 2016, the stock price was around 34, 33, 34, 35, and then 2 years later, in 2018, at the bottom, it was like at $27, and it took until like 2019, so 3 years to actually go above $35. So just keep that in mind when you're going crazy about a stock price that is not doing well for like 18 months. I mean, are you really investing for 18 months, or are you investing for like 18 years or more, right? So that's the thing. It's been a while. So what happens right now with Couche-Tard is the company has like slowed down in terms of earnings, in terms of revenue over the past 2 years. It's like the latest quarter was better. Now I'm waiting to see the next one that's going to come up. The story around 7-Eleven is definitely creating a lot of uncertainty. So investors don't know what's going to happen. I don't know what's going to happen anyway. So don't bother even asking me. But market doesn't like uncertainties. So right now, staying on the sideline, waiting to see how it develops. It's that type of stocks. I mean, it's not the first time, it's not the last time. When there's no hype around the stock, it's a pretty boring business. They're running convenience stores, so not much growth there at this point. We'll have to wait until they grow by another acquisition, or they come up with and they already have like a very solid plan for the next few years coming up. I trust management, so I'm not worried at all. But right now, down 13%. It's one of my largest positions, so definitely not helping my portfolio right now. But that's okay. I don't mind. I'm willing to hold on to this one for a while, so it's all good. But just to give you that kind of like perspective of what's going on with some of your stocks, determining like what's the weight, what's the reason, also why you have it in your portfolio, and if it's all good, well, then you keep on holding. So right, Moose, I'm already up to 12 minutes now, so I hope that you will enjoy your day, and tomorrow we are going to talk about 4 financial lessons from retirees that are coming from my community retirement loop. That's going to be fun, so don't forget to stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.